Meta Platforms, aka Facebook, is doing something pretty interesting and might have some investors worried. They are building up debt. And this is insane because this is a company with over $40 billion in cash and no long-term debt at the moment. So why does it need to do this? From this SEC filing that came out a few hours ago on August 4th, they mentioned some of the reasons they want to build up the debt. The first reason is they can use it for capital expenditure. So they're planning on using more money for data centers. I can kind of see that as this is a company focusing more in artificial intelligence. The second reason could be for repurchase of shares. This is a company that has been buying a lot of shares in the past few quarters. Are they gonna buy the dip a little bit more? The third and fourth reason are actually acquisitions and investments, and I do believe this is the lowest probability of what they're gonna use the money for. So do you think the metaverse investment is getting too expensive for Facebook, or is this something else? Let's take a look in today's episode.
I do want to thank The Motley Fool for sponsoring this video, and make sure to check out fool.com/Jose to get the top 10 stocks to buy right now.
So at the beginning of the episode, I mentioned some of the reasons why this company is planning on building up that debt. But before, I just want to showcase how this company fundamentally is super strong. We can see in its most recent quarter represented somewhere around $40.5 billion in cash and short-term investments and roughly no long-term debt at the moment. One of the first reasons I mentioned was capital expenditures. And this is a company that has focused a lot on building up their data center, their engineers, their artificial intelligence solutions. The reason being is not exactly the metaverse like many people think, but this is a company that wants to become less dependent on third-party data and more dependent on its limited first-party data with the strength of artificial intelligence. But I do believe this debt that they are building up is not going to be used for this. And the reason being is because this is something that the company as a whole has known that they're going to do for the past few quarters. I mean, we can take a closer look at October 25th of 2021. A little bit less than a year ago. The company expected to spend roughly $91 to $97 billion in the full year of 2022. So because they had this kind of expectations multiple quarters ago, I do believe they had some form of plan on kind of financing that. So I don't believe the reason for them to build up this debt is going to be for more capital expenditures, especially since in the most recent quarter that they reported on July 27th of 2022, they mentioned that total expenses for this year is going to be somewhere between 85 to 88 billion, way lower than prior expectations. And if you are enjoying this episode, make sure to hit the thumbs up as it helps me grow my audience and is super supportive. And if you want to subscribe a little bit more, make sure to use my link at fool.com/Jose. So if they're not using the money for capital expenditures, maybe they're using it for acquisitions. I want to say I don't think that's the case either, and let me show why. We can take a closer look at this Wikipedia page and see that in the past year or so, the company hasn't really made much acquisitions. Many of the acquisitions happened in 2021, and most of them were within the augmented reality or virtual reality market to pretty much increase their Oculus or gaming solutions. At the end of July, there were actually reports that the FTC was actually suing Meta to block acquisitions of a VR fitness app. And I do want to say Meta most likely knows that the FTC has them on a very kind of tight leash, or is keeping a close eye on them. And we can see as they block this recent acquisition, it's gonna kind of hold back Meta to make any future acquisitions because they are fearful that kind of they're gonna be blocked again. So I don't believe the money is gonna be used for acquisition purposes either. Where I do believe the money is gonna be used is gonna be on stock buyback and share repurchase. And let me show why. So we can see this is a company that has about $40.5 billion in total cash and short-term investment. And we can see compared to the peak of 2021, this is much lower. And why is it much lower? Well, we can see at the same time when we saw a huge dip in cash and short-term investments, there was a huge growth in stock buyback. So this is a company that has been buying back its shares at a strong pace. And some people may be like, Jose, well, they're buying back a lot of shares because they are diluting their shares very heavy. Honestly, it's the opposite. We can see this blue line is their average diluted shares outstanding, and it continues to dip very heavily. And if we take a closer look at the stock price, which is now the blue line, where Meta started buying a lot of their shares, it's actually when the stock started falling a nice amount. So to my best guess, I would say Meta Platforms is planning on buying the dip on its stock. And as a Meta investor myself, I'm actually not too happy about them building up debt, but But if they are planning on repurchasing shares and at a very aggressive pace, and they don't really want to reduce that cash flow, then to me, I understand, right? Cash is always cheap, and it's better to kind of have that cash just in case things go wrong. So I don't necessarily mind it if they're using it to buy back these shares at the moment. Obviously, every investor is different, and maybe you might not like it. So let me know in the comments below. What are your thoughts? Take care, have a good day, and see you next time.